So, what if I told you that there's one single idea that shapes pretty much every financial decision you could ever make? I'm talking everything from buying your morning coffee to giant corporate mergers. Well, it's called the time value of money. And honestly, understanding it is like getting a financial superpower. So let's dive in and unlock it.
All right, let's just jump right in with a choice. Imagine I'm offering you 1 million won, right here, right now, cash in your hand. Or you can wait 1 year and I'll give you 1.1 million won. Now, what's your gut reaction? That extra 100,000 won sounds pretty tempting, doesn't it? But the best answer, well, it's not so simple, and figuring it out is the key to this whole conversation.
Okay, so to really make the right call in a situation like that, we first need to wrap our heads around one core concept. It's a really simple idea, but believe me, it has massive implications for your entire financial life.
And that concept is the time value of money. The basic idea here is that money's value isn't fixed, it actually changes over time. A dollar that you're holding in your hand today is worth more than the promise of that same dollar a year from now. And why is that? Well, it all comes down to potential. Money you have now can be put to work immediately. It can be invested, it can earn interest, it can start growing.
You know, economists have a pretty fancy term for this. It's called a liquidity preference. But really, it's just a sophisticated way of saying something we all instinctively know. People would rather have cash or liquid assets right now instead of later.
So, why do we all feel this way? Well, it really boils down to 4 key things. First, there's just time preference. We're human. We're wired to want things sooner rather than later. Then there's that silent killer of value, inflation, which means the money you get in the future might actually buy less stuff. And this one is huge, opportunity. You could take that money today and invest it. And finally, there's uncertainty. The future is never, ever guaranteed. A promise is just a promise, right? But cash in your hand is a sure thing.
All right, so we've nailed down why a 1 today is more valuable than a 1 tomorrow. Now for the fun part. Let's get practical and see how we can actually calculate this difference and put a real number on the value of time.
So the first way we do this is by looking forward. We ask ourselves, okay, if I have this much money today, what's it going to be worth at some point in the future? This is called its future value. And the engine that powers this growth, the process of earning a return on your money and then earning a return on your returns, that's called compounding. The best way to picture compounding? Think of it like a little snowball at the very top of a big, snowy hill. As it starts to roll, it picks up more snow, right? It gets bigger and bigger, and as it gets bigger, it picks up snow even faster. Your initial investment is that tiny snowball, and the returns are all the new layers of snow it picks up on its way down. Okay, let's make this real with some numbers. Let's say you invest 10,000 won. Right now, today, at year 0, its value is, well, it's 10,000 won. This is our starting line.
Now, after just 1 year, earning a nice 5% interest, your investment has grown. You've made 500 won, bringing your total up to 10,500. Your snowball is officially rolling.
Okay, now let's fast forward to the end of year 3. Your investment is now worth 11,576 won. And here's the magic. This is the really cool part. You didn't just earn interest on your original 10,000. You earned interest on the interest you made in year 1, and then you earned interest on that interest in year 2. That is compounding in action. So that's looking forward in time to see what our money can grow into. Super useful. But what if you need to do the exact opposite? What if someone promises you money in the future and you need to know what it's actually worth today? Well, that's the other side of this time value of money coin. This is what we call present value. It answers that crucial question, what is a future pile of cash worth in today's terms? And the process for figuring this out is called discounting. It's literally just compounding, but in reverse. Think of it this way. If compounding is like watching that snowball get bigger and bigger as it rolls towards you, discounting is like seeing a giant snowball way off in the distance and looking at it backward through a telescope to figure out just how tiny it must have been when it first started its journey. All right, let's try a new example. Let's say your goal is to have exactly 10,000 won in your account 3 years from now. That's our target, our amount in the future. Okay, so let's start reeling that future goal back to today. We'll use what's called a 7% discount rate. So to hit that 10,000 won target in year 3, how much would you have needed back in year 1?
We work it backward and find out you'd only need 8,734 won because it still has 2 more years to grow. And if we bring it all the way back to today, the present value of that future 10,000 won is just 8,163 won. And what this means is, if you can earn 7% on your money, then investing 8,163 won today is financially the exact same thing as someone handing you 10,000 won in 3 years. See how powerful that is?
So you see, when you boil it all down, future value and present value are just two sides of the same coin. Compounding asks, what will it be worth, and pushes money forward in time, making it grow. Perfect for savings goals. Discounting asks, what is it worth today, and brings money backward in time, making it shrink, which is absolutely essential for things like loans or valuing a business.
Okay, enough with the theory. We've got the concepts down. Let's talk about why any of this actually matters to you in the real world. Because trust me, this isn't just an academic exercise. This is a genuine financial superpower you could start using every single day. I mean, just look at this. It's everywhere. And your personal finances, it's the engine behind your savings plans, how loans are calculated, how pensions work. For investors, it's how you compare different opportunities or figure out what a stock is really worth. And businesses, they use it constantly to decide if they should launch a new product or buy a big piece of equipment. It is truly the bedrock of finance.
At the end of the day, this isn't just about crunching numbers. It's really about a total shift in mindset. It forces you to recognize that the financial choices you make right here, today, have this supercharged, amplified impact on your future.
Let's make this super practical. Think about a car loan. The bank gives you 4 million won today. That's the present value, right? Then they calculate a fixed payment that's designed to cover that amount plus all the future interest they'll earn. But look at your first payment. A huge chunk of it, 400,000 won, goes straight to interest. Only the little bit left over, the principal, actually goes toward paying down your debt. The entire structure of that loan is built on this concept.
All right, we've covered a ton of ground, from a simple choice to the nuts and bolts of future and present value. Now, to really leave you with a sense of how big this financial superpower can be, let's look at one final, absolutely mind-bending historical example. We've all heard the story. In 1626, Dutch settlers bought Manhattan Island for goods worth about $24. It's always called the greatest bargain in history. But was it really? Let's think about it. If the sellers had taken that $24 and just invested it, letting it compound at 8% a year, by 2004, it would have grown to over $103 trillion. That's a sum of money far greater than the value of all the real estate in Manhattan today. It just goes to show you, the most powerful force in finance isn't just money. It's money plus time.